Hello, this is David Starr, and I am here putting together this video to share with you some troubling signs that I am seeing here in the US equity market. Now, I know this video is coming on the heels of some big banks telling us that we are in a new bull market based on this move up off of the October low and the extent of the recovery that we've seen here in the S&P. But or those pronouncements notwithstanding, I'm seeing a lot of troubling signs. Now, some of those concerns, but only some of them, start with the manner of the rise from the October low, and those are apparent when we view the bounce through the lens of Elliott Wave analysis. Elliott Wave is the idea that when markets are moving in the direction of trend, say this move up from the 2020 low, they have a 1, 2, 3, 4, 5 wave structure. But when they go against the trend, like I think we're going down from the all-time high into the October low, they have a 3-wave structure, which we label A, B, C. There are a number of different characteristics that make the behavior of these 5-wave trend moves and these 3-wave counter trend moves appear different from each other and give us clues as to whether we're going in the direction of trend or against it. But one of the main ones is apparent here, that when you get a third wave, such as this portion of the rise up from the 2020 low, it goes so far that when you get a 4th wave pullback, small as this one might be, it stays completely clear of the initial leg to the upside here in wave 1. Now, that's quite distinct from what we expect to see in these 3-wave moves, right, where we get a leg to the downside, a move to the upside, and then another leg down, and then the subsequent bounce goes deep into the region of this prior decline, right, up above this swing low. And you can see that the bounce from this October low goes pretty much above all of the swing lows that we put in down from the all-time high. At the same time, right, nothing about the entirety of the move down from last January can be viewed as a completed 5-wave trend move. And that does suggest, right, that this move down from last January is a counter trend move. But it doesn't mean that the counter trend move is over, right? What we would expect if we had finished coming down into the October low in a counter trend manner and we were rejoining a long-term uptrend, then we would expect to see the behavior up from that October low exhibiting trend-like behavior. But it doesn't, right? Even in the initial part of this bounce from the October low through December highs, this market goes up, down, up, and then back within the range of the initial leg, right? Similarly, we continue up and then deep back below all of the swing highs. We go up, right? Making a new high in February, back below the prior swings. And so even though we continue up, it is in this overlapped manner, which is generally suggestive of a counter trend move. Now, for the moment, this advance that we've seen off of the October low is continuing to make a sequence of higher lows. And so while it looks counter trend to the upside, right, these continued higher lows certainly allow for the fact or the possibility of one of the moves just starting to extend much longer than some of the prior advances. But for the moment, that's not what I'm seeing. And that's suggestive of the idea that while the move down from the all-time high may eventually turn or end up being counter trend, and we may turn back up and make new all-time highs, it suggests that the move down is overall a counter trend move, but needing a new another good counter trend move down before turning up. And because that's what we would expect to happen if the move down in here into the October low was counter trend, but the bounce from there was counter trend as well. And the size of that next leg down, should it come, could very well be quite similar to the size of the initial move down off of last January's high. That could take us perhaps down to the 3,000 level. And while we'd have to gauge the potential size of the decline later, once it starts, once we actually confirm a turn back down is happening, and all that we can sort of insist on if this is an ongoing decline from the all-time high is that it makes a new low back below last year's nadir. We can certainly identify either way that if we are still heading down, there's a good size move to go. And while we're on the subject of proportionality of moves, we're only right now, as of Friday, sort of June, June 9th, right? We're only then reaching to the 61.8% retracement of the decline from the all-time high. That's an area where bounces often tend to fail. Not only does that proportion come in here, but another Fibonacci proportion, that is looking at the decline here, February through March, leading to the move back up into that high. Right? We often see that this resumption of a move after a pullback tops out at either 127.2%, this green line, or 161.8%, this green line, of that prior decline. And that 127.2 level clusters tightly with that 61.8% retracement. We're right up against the August high where potential resistance might come in, and 4,300 round number potential resistance. So both Fibonacci and Elliott wave analysis are giving us reasons to have some degree of concern right here. But those are not the only reasons for concern. Take a look at this chart, which shows in white a chart of the S&P 500, a daily chart, and then the blue line here, which is cumulative NYSE breadth. And we'll see leading up into the all-time high last January, as price was making higher highs, cumulative breadth diverged by making lower highs. We can also see that back through here, right? Higher highs in price, lower highs in cumulative breadth. So this situation went on for a little while, but it is relatively rare to see these cumulative breadth divergences, and it is a well-known warning sign of potential significant declines, such as what we saw last year, to see these cumulative breadth divergences. And while we didn't see it at the start of the move up from last October's low, right? Making higher highs in cumulative breadth as we made higher highs in breadth, right? Making higher highs here in both, such that things were confirming the move up. We're not seeing that since February, right? Versus February here in June, we're making higher highs in price, but lower highs in cumulative breadth. Now, if we continue upwards and it's able to drag cumulative breadth up to higher levels relative to what we saw in February, then perhaps we start to again confirm the move up. But for the moment, that's not what we're seeing. And it doesn't stop there. Let's go ahead and pull up some other charts and look at some more market internals, where we can see an extremely elevated CBOE skew index, right? Printing here above 150 on here on Friday. That's June 9th. If you're watching this video a while after I recorded it, we got higher in the 150s, but certainly well over the 135 level that would consider this a relatively really one of the higher levels that we see out of the skew. It has been higher, of course, but this elevated skew is a strong warning of a market that is susceptible to a significant decline. We can also see the this white line here, which is the 10-day moving average of the all-issue put-call ratio. It's one of the lowest levels that we've seen in quite a while, meaning everybody's buying calls, nobody's buying puts, nobody has protection on in this market. And while that doesn't mean that we have an imminent sell-off, it does mean that if we do start to see some selling from the area we're at right now, where the S&P 500 is stretched well above its 21-day exponential moving average, well beyond 2 standard deviations above that, not quite to the 3 standard deviation level, although we poked up close to that a few times in recent days, right? Stretched above that level, if we do start to come back in, folks have very little protection, and that could allow a move to snowball and start to turn into a bigger decline. All of these things that I'm looking at paint the picture of a market that is in a precarious situation. At the same time, none of the signs that we're seeing tell us that a move down, should we get it, is imminent. There certainly are some Elliott Wave patterns which could be close to done on shorter time frames as well as larger ones, but that doesn't mean they are done. And so the way I want to process warnings like this is to tighten up stops on long positions, to take some partial profits on long positions. But it doesn't necessarily mean that we turn down tomorrow or the next day or at all, right? So we have to be attuned to the behavior of the market shifting from one that appears to be heading up in a precarious and potentially counter-trend manner to one that is actually heading down in a trend-like manner. And those are signs that we'll be watching for pretty closely in our simpler trading rooms. But for now, I wanted to show you why I'm concerned about this market, show you objective signs of things that tend to happen into tops, right? Like patterns to the upside being reasonably complete, like high skew readings, low put call readings, like cumulative breadth divergences, which happen rarely but tend to happen before moves to the downside. These are things that are well known as events which tend to happen leading into declines. And while we can't confirm a decline yet, we really should, if we believe in the history of these things, we really should be on guard for that starting to happen, taking protective steps, and starting to look for confirmation of those turns. So I hope you found this useful, and I will be back again with useful information as I see it.
Hey, David here with Simpler Trading. Thanks for taking a few minutes to watch this video. I hope you found it useful. And if you did, please help us out. Click the like button. You can also add your comments below. We love to read those and respond to them. You can also click the bell icon. That will alert you whenever we have new and updated videos. And if you want to watch us trade in real time with our own money, you can visit simplertrading.com to learn how to sign up. Until I see you again, as always, good trading, and we'll see you at the next video.